Ever looked at a trading chart and felt like you were reading ancient code? Candlestick patterns are the hidden language of the market, and once you understand them, they can reveal powerful clues about what's coming next. In this video, I'll break down the most important candlestick patterns every trader should know, what they mean, how to spot them, and how to actually use them in real trades. Whether you're a complete beginner or just need a refresher, this will make everything click. Let's decode the charts. The engulfing candle. This pattern is a game changer for spotting reversals and trend continuations. If you've been struggling to find reliable setups, pay close attention, because this is where smart traders get their edge. What is an engulfing candle? All right, let's keep it simple. An engulfing candle is a two-candle pattern that signals a potential shift in market sentiment. There are two types: bearish engulfing. A red candle completely engulfs the previous green candle, signaling a potential downtrend. Bullish engulfing. A green candle completely engulfs the previous red candle, signaling a potential uptrend. Key rule: the second candle must be bigger than the first one. No half measures here. It has to dominate. Why is this pattern so powerful? The engulfing candle isn't just any pattern, it's a shift in market control. When bulls or bears completely take over, it tells you that momentum is shifting. And smart traders? They capitalize on these moves early. Think about it. If buyers were in control and suddenly sellers step in with overwhelming force, what does that tell you? A potential reversal is happening. How to trade the engulfing candle. Step 1. Identify a key level. Look for support or resistance zones where price might react. Step 2. Wait for confirmation. Don't rush in. Let the candle close before making a move. Step 3. Set your entry and stop loss. Enter after the pattern confirms. Set your stop loss below for bullish or above for bearish, the engulfing candle. Step 4. Target the next key level. Use previous highs, lows, or Fibonacci levels for profit targets. Pro tip: always check volume. A high volume engulfing candle is way more reliable than one with low volume. Let's look at some real charts. Here's a bullish engulfing at a major support zone. Price reverses and boom, massive rally. Now here's a bearish engulfing at resistance. Price collapses right after. See the power of this pattern? Engulfing candles are one of the best price action signals if you know how to use them. Remember, look for strong engulfing formations. Trade them at key levels for higher accuracy. Confirm with volume for extra confidence. Candlesticks visually represent market prices on a chart, but they're not the only way. You also have bar charts, line charts, and others. However, candlesticks are among the most popular. A candlestick consists of two main parts: the real body and the shadows, also called wicks. When analyzing candlesticks, it's crucial to understand that each one reflects four key price points: the opening price, the high, the low, and the closing price, commonly referred to as OHLC. The real body shows the open and close prices, while the shadows above and below indicate the highest and lowest prices reached during that period. These wicks signify price rejections, with the upper wick marking the high and the lower wick marking the low. The highest price represents the peak during that time frame, while the lowest price indicates the bottom. Candlestick colors typically follow a green and red scheme, though some settings use white and black. Most importantly, the placement of the opening and closing prices determines whether a candle signals bullish or bearish momentum. If the opening price is lower than the closing price, the candle is green or white, signaling bullish movement. Conversely, if the opening price is higher than the closing price, the candle turns red or black, indicating bearish momentum. The longer the real body, the stronger the price movement in that direction. While there are numerous candlestick patterns, like engulfing candlesticks, shooting stars, hammers, and spinning tops, memorizing them all can be overwhelming. But don't worry, I'll show you an easier way to analyze candlesticks by focusing on just two key factors: the open, high, low, and close OHLC values, and identifying whether bulls, buyers, or bears, sellers, dominate the market at a given time. Let's begin by examining a powerful bullish candlestick pattern, the Marubozu. A bullish Marubozu is a solid green candle with a large real body and no wicks, meaning buyers controlled the entire session. Its OHLC values reveal that the closing price is higher than the opening price, with no price rejection from sellers. This makes it one of the strongest bullish signals. However, real market conditions aren't always textbook perfect, so some flexibility is necessary. A slightly modified version with small wicks can still be considered a strong bullish pattern if selling pressure is minimal. On the flip side, a bearish Marubozu is its opposite, featuring a large red body with no wicks, signaling aggressive selling pressure. The open price aligns with the high, while the close price matches the low, indicating sellers dominated throughout. This makes it one of the most powerful bearish patterns, showing no resistance from buyers. Lastly, let's discuss Dogee candles. Dogee are similar to spinning tops, but have no real body, meaning the opening and closing prices are exactly the same. These patterns provide crucial market sentiment insights. A Dogee represents a moment of indecision, where neither buyers nor sellers can gain control. The presence of wicks indicates attempts to push prices higher or lower, but since the session closes at the opening price, neither side prevails. Like spinning tops, Dogee suggest caution, warning traders of potential reversals or consolidations. While there are many more candlestick patterns, understanding these core ones provides a strong foundation. Now, let's rank them by strength, starting with the most powerful bullish patterns. Then we'll arrange bearish patterns from strongest to weakest. Keep in mind, though, that you shouldn't trade these candlesticks in isolation. More confirmations lead to better decisions. The key takeaway is to understand what each candlestick pattern signifies, then incorporate this knowledge into your trading strategy. Now, let's move to the next category, pin bars. These include hammers and hanging men. A hammer forms at the bottom of a downtrend and features a small real body at the top of the candle with a long lower wick, indicating bullish reversal potential. The long wick shows that while sellers initially pushed prices lower, buyers stepped in and regained control. This shift in momentum often signals a reversal. Meanwhile, a hanging man resembles a hammer, but appears at the top of an uptrend, serving as a bearish reversal signal. It suggests that bears are entering the market, overpowering bulls, and potentially reversing the trend. Another type of pin bar is the inverted hammer. An inverted hammer forms at the bottom of a downtrend and signals a possible reversal, though it's a weaker bullish indicator than a regular hammer. It features a small body with a long upper wick, showing that buyers attempted to push the price higher, but were met with selling pressure. If given a choice, I'd trade a hammer over an inverted hammer because the former provides a clearer reversal signal. Conversely, a shooting star appears at the top of an uptrend and acts as a strong bearish reversal pattern. It has a small body with a long upper wick, indicating that bulls attempted to push the price higher, but were ultimately overpowered by bears, forcing a close near the opening price. This makes the shooting star a stronger bearish signal than a hanging man. The morning star is a bullish reversal pattern that appears at the bottom of a downtrend, signaling a potential shift to the upside. It consists of 3 candles: a large bearish candle, a small indecisive candle, which can be bullish or bearish, and a strong bullish candle that closes near the midpoint or higher of the first candle. This formation indicates that selling pressure is weakening and buyers are gaining control. A well-formed morning star suggests a strong reversal, especially when confirmed by high volume or support levels. Compared to a single candlestick pattern like a hammer, the morning star provides a more reliable signal due to its multi-candle structure, showing a clearer transition from bearish to bullish momentum. The evening star is a powerful bearish reversal pattern that signals the potential end of an uptrend. It consists of 3 candles. 1. Strong bullish candle indicates continued buying pressure. 2. Small-bodied candle, Dogee or spinning top, shows indecision in the market. 3. Strong bearish candle confirms the reversal as sellers take control. Grade A. The bearish candle fully engulfs the first bullish candle. Occurs at a key resistance level. High volume on the bearish candle. Grade B. The bearish candle is strong but doesn't fully engulf the first candle. Moderate resistance level. Average volume on the last candle. Grade C. The bearish candle is weaker with a smaller body. Occurs in a less significant resistance area. Lower volume, making confirmation less reliable. Best used on daily and 4H charts. Confirmation. Look for additional bearish signals, RSI divergence, moving averages. Trading tip. Enter after confirmation with a stop loss above the small-bodied candle. Now, let's discuss the third category, spinning tops. These candles have small real bodies with nearly equal upper and lower shadows. The small body suggests that the opening and closing prices were close together, meaning neither buyers nor sellers had complete control. The upper shadow signals an attempt by bulls to push prices higher, while the lower shadow shows bears trying to pull prices down. Since neither side established dominance, spinning tops indicate market indecision. If a spinning top forms in a downtrend, it suggests that bears are either taking a break before continuing their selling or that bulls are attempting to reverse the trend. However, because there is no clear winner, the outcome is uncertain. Prices may either resume their decline or start moving upward. Traders should prepare for both possibilities. The same applies in an uptrend. So now you know, candlestick patterns aren't just shapes on a screen. They tell a story of bulls and bears, momentum and hesitation, reversals and breakouts. Start watching for these patterns in your next chart session, and you'll never see the market the same way again. If you found this helpful, hit that like button. It really supports the channel. Subscribe if you want more trading tips that actually make sense. And let me know in the comments, which candlestick pattern do you trust the most?